All right, welcome everybody. This is August 9th, 2023 here. And it's been a big important year for all of your portfolios, all of you guys financially. We are coming out of the 2022 bear market. So, hey, pat yourselves on the backs. You guys all made it through. You survived. Congratulations. This was kind of a big deal, the 2022 bear market, because this was really the first kind of real bear market we've been through since the 2008 financial crisis. The bear market of 2020 with the COVID crash, that rebounded so fast that none of us had really gotten a chance to even feel that drop. I mean, it was scary at the time, let's not lie, but it was over with so quick. It wasn't normal. This was a longer, more normal bear market. And one of the things we're going to talk about today is where are we in the cycle? How did this bear market kind of compare to previous ones? And then what should you expect of the markets and of your portfolio in the years to come? So as always, there will be time to ask questions at the end, but we're going to start today with an update from Dru Brooks on an update on the banking sector, which is something we've been focused a lot on since Silicon Valley Bank collapsed earlier this year. So he's going to be providing an update for you on that. Let me go ahead and pull up the presentation for you to review. Okay. Okay. Yeah. So here we go. Banking sector. Go ahead, Dru.
Hey everybody, hope you're doing well. So regarding the bank failures from what we talked about in March, including Signature Bank, SVB, and PacWest, there's a couple updates for you guys. As interest rates continue to rise, these small to mid-sized banks didn't have the liquidity needed for all client withdrawals taken. Now, Moody's has cut the credit rating for 10 more banks of similar size and has warned that the banking sector's credit strength will be tested by funding risks and weaker profits down the line. If you have any significant funds still held at any of the banks in the news, please reach out to us. What you can do to protect yourself in the meantime is to make sure all of your accounts are under the $250,000 FDIC insured limit. Each account ownership type gives you a separate $250,000 of coverage per bank. So if you have an individual account, a joint account, and another joint account with a beneficiary listed on that, that gives you three separate $250,000 FDIC limits for coverage. And that's, again, per bank. So if you do that for two separate banks, you have 6 different accounts with that. So one last quick thing for me is regarding the Schwab transition. So if you've already had a TD Ameritrade login set up, you'll receive instructions from us shortly on how to set up that Schwab online access. And if you don't have a TD Ameritrade login still, please contact our office. And if not, Nicole or Yehuda in our office will reach out to you. If you haven't already, you should receive a letter from Schwab in the mail with your old TD account number and your new Schwab account numbers. Over the Labor Day weekend, early next month, your accounts will begin to transfer over from TD Ameritrade to Schwab and will be visible to all of you on the following Tuesday, September 5th. So that's in the works right now. I believe most of you still at TD have already created your login, so that'll help the process for you.
Excellent. And of course, if any of you have any questions, any concerns, if this is the first you're hearing about your accounts moving from TD Ameritrade to Schwab, please reach out to us. We are trying very hard to over communicate with all of you about this. It really should be a non-issue, a non-event. But we are kind of overdoing it to make sure that nobody is surprised, nobody logs in on the Monday or Tuesday after Labor Day and goes, "Oh my God, what's going on?" Right? So please reach out to us. We're here to help. All right, let's talk about where we are in the market and the portfolios right now. This is this is month, you can call this month 20 of the 2022 bear market, and I'm going to call it that for now because I kind of want to put this bear market into context a little bit. So here's what we've gone through. Okay, this chart is one you guys have seen before. I've just been updating it along the way, but this bear market started in January of 2022. Right off the bat, we were communicating with you guys in January, on January 25th, letting you know, okay, hey, the market's dropped. So far, this is just a correction, and corrections happen, but it's important to take the long-term view. Then by February, it was pretty clear that this was going to be maybe more than a correction, that the market was truly dropping, and we were letting you know what we were going to be doing to manage your portfolio in a downturn. By May and into July, we were talking about how long it would take for your portfolios to recover from a bear market. I'm going to show you one of the earlier slides that I had created in May and give you an update on that. Then in August, it was kind of a head fake. August was a head fake. I thought that maybe this bear market was already over because we had this big spike in the market, and then it just immediately came plummeting back down. Okay, the market hit a low in essentially like October 1st of 2022. Okay, so it took from January of 2022 to October of 2022 for the market to go from top to bottom of the bear market. Okay, it was a drop of 25%. Okay, so 25% in about 9 or 10 months. Okay, then from October 1st of 2022 till now, all right, we've had an increase. Actually, that's not supposed to be a negative. That's supposed to be a positive. We have an increase of 25% in the market. Okay, from the bottom to now the top of the market. All right. Along the way, we were letting you know, hey, in January, let's start getting some cash to work. Let's take advantage of this market recovery. In March, we gave you the update on the banking collapse. Around May, it was looking like, okay, this is probably a recovery, but it could go either way. And we were letting you know about that. And now in August, I'm saying this is absolutely a recovery. The portfolios are on their way to full recovery, new market highs, and now I'm going to kind of let you know what to expect going forward. All right, so this is the slide that initially I had shown you all the way back in May of last year, and it was, what should your expectations be on the recovery of your portfolio? How long would it take? Okay, and what I told you was how long it would take to recover would really depend on how far we dropped. Okay, and at the time we didn't know. We didn't know whether it was going to be a correction, a bear market, or a full-on recession. What it ended up being was sort of right in between a bear market and a recession, okay? Because we didn't kind of really officially have a recession, but the market dropped kind of commensurate with a recession. So I'm going to kind of put it right in between those two. And what I said was, when the market drops 20 to 25%, you should expect it to take somewhere between 16 and 24 months to reach full recovery. Okay, well, right now we're in month 20. Okay, so we're month 20. Month 24 would be average for a recessionary drop. So we're still kind of on average on our path towards full recovery. Okay, this is a very kind of normal bear market recession. I did say that it could take up to 5 years. It's very clear that this is not going to be that type of market drop, or this wasn't that type of market drop. And so, here we go. Kind of everything's gone more or less according to plan so far. Okay, so just a little bit a reminder of the big strategy movements that we made, okay? Both in preparation for this bear market and then taking advantage of the opportunities that presented themselves in this bear market, okay? So before the bear market hit back in December 2021, again, we didn't really know a bear market was going to happen the next month, but we were very worried that possibly stocks could drop at the same time as bonds dropping, okay? And the reason we thought bonds might drop was because we all kind of knew interest rates had to go up. We just didn't know how fast it was going to happen, okay? So in preparation for that possibility that stocks and bonds might drop at the same time, we sold a big chunk of all of your bond portfolios, okay? And for most of you, we moved them into structured notes. Some of you guys declined, you didn't want to do the structured notes, that was fine. But most of you, we sold those bonds and moved them into structured notes, okay? That gave you a little extra protection to ride out a bear market in case it was longer than average. That's really what we were trying to protect you from. Trying to protect you from a bear market that was maybe longer than that average of 2 years to full recovery. As it is, this ended up being a pretty average, bear market, okay? But we were preparing for maybe something worse than average. Then at the very bottom, we couldn't have timed it better. At the very bottom, in September of 2021, we did another bond sale. We sold bonds and we bought stocks. That was a little bit of a painful move because we were having to sell bonds low to buy stocks lower, okay? We never want to sell low if we don't have to, but we just really felt strongly that the best opportunity for growth going forward from that moment in September, the best opportunity for growth was going to come from the stocks, not from the bonds. And we were absolutely right about that. We bought those stocks, and since then, we've enjoyed a 25% increase in the stock market from September of last year to date. Okay, so now we're in a cycle where we're now moving from a bear market management to a bull market management, okay? And if we stop thinking of this as month 20 of the bear market, then we need to start thinking of this as month 11 of the bull market, okay? We're almost 1 year into a bull market, right? It's like, who'd have thought? It certainly doesn't feel that way, but that's the reality. We are now in almost a full year of a bull market. So we have to change the way we think about how to manage the portfolio to maximize your returns for a bull market. Okay, so here's where we're at in the cycle, okay? We've already been through the peak, we've been through the drop, we've made it through the trough, now we're into the recovery, all right? And when I showed you this slide back in May, I said, maybe there was a 1/3 chance, maybe a 34% chance that we might slide into a double dip market, slide into a recession. Now I'm decreasing that all the way to less than a 20% chance. I feel very, very confident that the likelihood of a recession is behind us in the rearview mirror, and that probability of a recession has only been decreasing. I mean, when we were talking at the bottom of the market in September of 2022, at the very bottom, I was saying okay, maybe like almost a 50-50, not quite a 50-50, but almost a 50-50 chance that we would go into a recession. But the likelihood of that happening has continued to decrease as this recovery has become real. Okay, and now we're at something less than a 20%, essentially any normal chance, all right, of a recession. Okay. All right. So again, looking back at previous market cycles, okay, how did what we went through compare to what is normal, and what might we expect now of this bull market that we're 11 months into? Okay. So here's some statistics all the way since 1980. Okay. So it's not going back super far, but of kind of our modern economy. Okay. Bull markets, on average, a bull market lasts about 850 days, okay, about 3.5 years, right, is the typical bull market, which means if we're now 300 days into it, okay, then we have about, 550 days to go on average for this bull market, okay? And the typical bull market enjoys almost 100% returns from bottom to top, okay? And we're about 25% return from bottom to today. Okay, so we might have another 75% growth on average, okay, to go. All right, so which means it's not over yet, right? It's not too late. You haven't missed your opportunity if you're sitting on too much cash. The opportunity has not passed you by, okay, but we are, a year into this bull market, and an average bull market lasts about 3.5 years. Okay. Now, on the flip side, the bear market that we just went through, okay, that bear market only lasted about 270 days. Okay. Only 9 months from top to what we now know was the bottom in September, October of last year. 270 days is just slightly longer than the average bear market. Okay, the average bear market lasts about 230 days and is a drop of about 28%. This bear market lasted about 270 days and dropped about 25%. Again, very, very normal. What we've just been through is very normal, and it will happen again, right? It's just a matter of time. This bull market is not going to last forever. Okay, we were spoiled because our last bull market was when we came out of the financial crisis of 2008. That lasted almost 10 years. Okay, that lasted way longer than normal. Okay, all right. A typical bull market's only going to last about 3.5 years. Okay, of which we're about a year into it before we got to go through this whole volatility mess all over again. Okay, so then how are most of your portfolios performing? Okay, now this slide goes with a huge caveat, and the caveat is because the market has been so insanely crazy volatile the last 3 years, the biggest determinant of what your individual performance is when we started working together. Okay, because if we started working together in March of 2020 at the bottom of the COVID crash, your returns are much better than this. Okay, if we started working together late in 2021, right before the bear market began, your returns are worse than this. Okay, but these are the average returns for our clients in our top 3 portfolios. Okay, so if you are somebody who is 5 years or more away from retirement, we probably have you in our growth portfolio. Okay, that's the name of that portfolio. All right, target return for that portfolio is around 8 to 9%. Okay, and the returns the last 1 and 3 years have been in the mid 5s. This is all on an after fee basis. Okay, so over the last 1 to 3 years, the returns have been under target. Okay, that's important. Okay, but year to date, those returns are right on target, right? 9.5%. If you are in your early retirement or just pre-retirement, we probably have you in our growth and income portfolio with a target return of 7 to 8%. And you can see the returns over the last 1 to 3 years have been anywhere from 3.5 to 4.5%. And year to date is about 9%. And then finally, our most conservative portfolio that we run for most clients is called our income portfolio, typically for very late retirement, has a return target of about 5 to 6%. Now, that's only been running about 2% per year over the last 3 years, 4% over the last year, and year to date is up a whopping 8.5%. Okay. Now, here's what's important when you look at returns compared to target return. Okay. there are always periods of time where your portfolio return is going to be above the target return. Okay. That was the case in late 2021. All of our portfolio returns were running above target. That's not sustainable. Okay. That's one of the big indicators we look for to know when we need to go more conservative, because these portfolios are designed very carefully to produce average target returns. So when the returns are running much higher than target, we know the market is probably a little bit too hot and we need to get defensive with your portfolios. All right. That's like the example of when we sold stocks in 2018 in preparation for a possible recession before the COVID crash. Okay. Now, there are also periods of time where portfolio returns are much less than the target return. That's a strong buy sign. Okay. That's when we typically shift into stocks to buy. Okay. Because again, actual returns will not run below target for very long. They always revert to the mean, right? They revert to the average. If returns are too high, they're going to come down. If returns are too low, they're going to come up. Okay. So we're always trying to sell high and buy low, which is why for many of you guys, you've been hearing me say, let's buy, because this is the buy low opportunity. It has been, and it still continues to be. Okay, so thoughts and predictions, all right? Again, very, very strong probability, very strong high level of certainty that this is a market recovery and that the market recovery will continue through the rest of 2023 and very likely will continue for at least another 2 years, okay? The Fed is almost certainly done raising interest rates. Aside from the 0.25%, they're going to do one more 0.25%. They've kind of already promised it. They've already forecasted it. It's already priced in, okay? I strongly believe and I hope that that's it, okay? Now, on the flip side, they're probably not going to lower interest rates either, okay? The market for a long time was predicting that interest rates would drop at the end of 2023. I don't think that's going to happen anymore. We all need to get used to this new level of interest rates, which I got to tell you, it's actually normal and it's healthy. The level of interest rates we have right now is totally normal, totally healthy. It's good for your portfolios, even though it hurts in a lot of other areas of our lives, okay? Inflation is going to continue to slow. The Fed's been very aggressive with these interest rate increases. We are seeing spikes in food costs, spikes in energy costs. That is not part of the long-term inflation calculation because those prices are just crazy volatile. They're always up and down. All right. So overall, inflation is going to continue to slow. All right. GDP growth is positive right now. It's going to continue to be positive and will probably begin accelerating as this bull market recovery continues. Okay, I'm going to bring it up now because I know you guys are going to be asking me about it for the next 18 months. And so I'm just going to get out in front of it and say what all of you guys already know. Elections are coming again, okay? And you are going to be bombarded with people telling you you should panic, okay? You panic for all these different reasons, right? Social media outlets are going to be telling you you should panic. Traditional media outlets are going to be telling you you should panic. I don't care what side of the aisle you are on. They're all going to be telling you to panic. Politicians are going to be telling you to panic. And commission brokers and scammers are going to be telling you to panic. The reason all of these people are going to be telling you to panic is because they all have a vested interest in your fear, okay? Social media and traditional media outlets, they make money off of your eyeballs, okay? The longer your eyeballs are glued to what they're spewing, the more money they make. And fear is an excellent motivator to keeping your eyeballs glued. Okay. Politicians, they get elected based on voter turnout. And they know the scareder they make you that the other side might win, the more likely you are to turn out and vote. They have a vested interest in creating that fear for you and that panic. Commissioned brokers and scammers, okay, they make money every time you make a change, every time you make a trade, every time they scare you that what you're doing right now is wrong, and if you don't do what they're telling you to do, the world's going to explode on you. Okay, that's how they make money. All of those people telling you should panic have a vested interest in your fear. You can count on at least one person in your life telling you you can pretty much just ignore it, and that's going to be us here at Village Wealth Advisors. We are the only fiduciary probably in your life, which means we are legally held to the standard of doing what's in your best interest. I'd make no money off of your fear. Okay. And I'm not interested in creating fear. I'm interested in telling you what is actually going on, what you should actually be focusing on, and telling you what you should ignore. And from a financial standpoint, one thing you can absolutely ignore are the coming elections, unless there's something very specific that I need to make you aware of. And usually that's things like tax policy, okay, or it's things like trade policy. Those are the two biggest economic factors that sometimes are affected by elections. But honestly, they're usually not affected enough to make a big difference. All right. Okay, there we go. So here we are, Village Wealth Advisors. We are here to help you with your financial planning needs, right? We're here to help you understand your money. We're here to help you make confident decisions about your money. We're here to grow your investments, and all along the way, keep you informed via the Zoom meetings that we do periodically, through the face-to-face meetings that we have. And then you guys always know you can pick up the phone anytime and schedule a quick call with either myself or Dru or Naivi or any member of the team. We want you to know that we're here during the transition that's coming up to Schwab. Again, it should be a non-issue, but if any questions do come up, please don't hesitate. Give us a shout out. All right, I am going to stop the share there and open it up to any questions anybody has. So if you do have a question, please go ahead and unmute and ask away. No questions? I could see my talkative clients took a day off today. All right. Well, hey, if anything comes up, shoot me a message. Happy to jump on and discuss your situation one-on-one. And yeah, enjoy the end of your summer. All right. Take care, everybody. Bye-bye.
Thank you, John.
My pleasure.